Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, small and mid caps are the talk of the town. Some see opportunities while others see risks. Today, with our in-house expert Dhirendra Kumar, let's cut through the noise and help you decode if this rally is worth riding or should you be cautious. Welcome, Dhirendra.
Thank you.
First up, are the mid and small cap stocks in a bubble right now, or is this a sustainable rally?
First and foremost, the honest answer is that I don't know. And assuming that I knew about it, I don't think we can really predict it, because whether it is in a bubble territory or not is entirely a function of lot of investors. If the market starts going up again, it'll look as if it was not in a bubble territory. A lot of investors pull out money. It looks like it was in a bubble territory. We only get to know of it with hindsight, only after it has happened. And it will be profitable to actually know it beforehand, to do it before all others, or before the decline, before the big fall. The fact is that, small and mid-sized companies do better over time, but they carry substantial risk. They carry substantial risk because small companies can wither away in an economic down cycle. They are small, they cannot withstand a very turbulent weather, economic weather. I'm not talking of market weather. So small companies are generally vulnerable. Now the point is that will you actually lose money? And when you look at very long-term returns, 10 years, 20 years, 15 years, then I find that smaller companies are risky. But the promise of a smaller company is that when they turn big, they are extremely rewarding, hugely rewarding, and that is the charm of small cap. Now, there are a lot of this is a very risky territory. This is a very risky category if you are going to participate in it yourself. Let me just tell you the reasons. The number of small cap companies listed in the Indian market is 4,586 as on today, which somewhat trade, of which 3,471 companies have traded every day, or at least 90% of the days in the past 1 year, which means that these are the number of active companies. And of which only the mutual funds invest in only 600 companies, 609 companies. So imagine a universe of 3,400 companies and mutual funds investing only in 609 companies. So the remaining company, 2,800, that is something where I think, that will be a landmine. That is where, you'll have many companies which will disappear. There will be many companies which do not exist, but they trade. You are buying in the stock of a company which might be worthless. So I think, mutual funds really deliver you a very high value in this segment. If you have to invest in large companies, then you have choice. You can invest in any of the bigger companies yourself. Dropping few companies from the 50 companies of the Nifty, about which the outlook might be bleak, is relatively easier. But here, of the 3,400 companies, the mutual funds have narrowed a universe of 600 companies. And then you are diversified. Then you are investing. And here, if you are when I look at some of the small cap funds, they are spread over 300 stocks, 250 stocks. It is a very difficult portfolio. I know for a fact that some funds are managed internally by 3-4 fund managers, because it is beyond one fund manager to keep an eye on those many stocks and in their portfolio. Small caps are very dangerous for the individual investor if you are venturing on your own. Small cap funds are very risky if you are investing for the short run. Small caps are very risky if you are investing for the short run and investing at one go, and you just invested in that and you invested your short-term money. But if you are doing your SIP, if it is 15, 20, 25% of your money, if you are doing your SIP with another 5, 7, 10 years in mind, and in this correction of 15, 20, 25%, you did not lose your sleep, then carry on. It is not in the bubble territory. And even if it is, we will only know it after you know that it was in the bubble territory, not before that.
Okay, so are you saying that investors should stay invested right now in small and mid cap stocks and should not be booking profits if they're invested for the long term?
Yes, if you accidentally drifted into small cap and this is your first investment, get rid of it. If you are losing your sleep, get rid of it. But if you invested for the long run and it has gone down and you are not losing your sleep and it is a part of your overall portfolio, make sure that you are investing through these lean times, because your investment made during these periods turn out to be the most profitable ones.
Right. So are large caps a better bet right now given the stretched valuations in mid and small cap stocks?
I don't know, because they are also not very cheap. If you look at the cheapest stock in the Nifty and the most expensive stock in the Nifty, I would say a good number of them, the ones on the higher side, they also don't look cheap. You figure out what is cheap, what is not, and also if you look at it in terms of volatility, because large caps are owned by foreigners, the FIIs, we have seen that in a crumbling market they fall more. They fall much worse than small caps. Of course, the risk of small cap is completely different. That some of these companies in the small cap universe, beyond what mutual fund invest, and including many companies where mutual funds do invest, some of these companies will simply disappear. They will die, and they will die unceremoniously. There won't be any. They will wither away without fanfare. In the large cap universe, nothing of that kind happen. But you are unlikely to find a multi-bagger in the large cap. So I would say that mid cap universe, you have some large cap as well, have some small cap, and have it in a portfolio so that you don't lose your sleep. That is why flexi cap, multi cap, value fund, ELSS, these are the mainstream categories through which most investors should invest substantial part of their money.
Right. If you had to list some of the key risks that are associated with mid and small cap stocks, what would they be?
All the risks, the business risks. Every business comes with its risk of economic cyclicality, or competition, or regulatory framework or some such thing. And the GST happened, and it was applicable to every business, and every business had to comply. It could have been disruptive. Besides that, small caps have other issue, which is liquidity. They are companies with small equity capital. Good part of it is held by promoters. Remaining part, if some investors sell, they are more volatile, they are more vulnerable, and they are also more vulnerable, and there can also be a liquidity crisis. If there is a good company, so many people want it, and there is a finite supply, so everybody buys it, and then there is no liquidity. Little bit of purchase, little bit of buying, and the price shoots up. So they could be extremely volatile on the buy and on the sell, and you may not be able to buy as much as you want to, and that is why mutual funds are more vulnerable when they in their small cap stocks holdings, because mutual funds have to buy something which is worthwhile for them, 100 crore, 500 crore, or 200 crore in a large fund for it to be meaningful. And when they try to buy it sometime, and if they are somehow able to buy it, if they choose to sell, then these stocks collapse. If 2 or 3 of them, so a small bad news can have a disproportionate impact on these small caps. So that is another risk. And of course, you have, as I said, that all the other business alternatives, but this is liquidity and promoters action. What happens is when you achieve a scale, then there are other other parties also become involved in it. You are able to professionalize the company. Smaller companies might still be vulnerable to an owner, and that is a risk which can be dealt with. That is, there is a reward. If there's a great owner and he's able to work on a succession plan, and he's able to transfer the good the professional handing over to a team which can take it over and carry it and run faster, harder, better. Nothing like it. And this is the opportunity, this is also the vulnerability.
All right, now for all the viewers who probably own mid and small caps and are jittery right now, what would be your word of advice? What should they do? What should be their course of action going forward?
My suggestion will be that try and stop looking at your, don't visit value research online to look at your portfolio values. Because if you need the money after 10 years, but you get nervous and upset and disappointed and sad every day. Avoid that. Do something else, because looking at the decline on a day-to-day basis, that actually distracts you from the big picture. Because in next 10 years there will be 1 or 2 more such occasions when there will be a big fall. And it is important that these are the period when you should make sure that you are investing, you are carrying on with your investment plan. And more importantly, if you can actually accumulate, have some more to invest, you will be buying cheaper.
Right there. Be disciplined, stay patient. That's what you need to do right now. But moving on to the viewer's question. Now, Sunil has sent in this question. He says, how does one review the fund performance of a mutual fund? How often does one need to do that? And how long should one wait before taking action for an underperforming fund?
It's pretty straightforward. There are many things which you can look at. I would say that, you should develop a very simple framework in which you should be able to, because you're investing in a mutual fund, you're investing in a fund where, you're entrusting your money to somebody and it is his, and you're incurring the cost. There is an expense ratio and you better be rewarded for what you are actually, entrusting your money for. Set up your portfolio at Value Research Online. Go to the performance section and there you can put a benchmark to compare your performance based on complex cash flow, because it becomes very difficult to compare. You will be doing your SIP in one fund for the last 5 years and you'll be doing your SIP in another fund for the last 3 years, and in between you would have taken some money out. So doing this comparison gets very difficult. Value Research Portfolio Manager, what it does is, it does a corresponding investment in BSE 500. And you can see that if you would not have invested in these funds but invested in BSE 500, would you have beaten it? If you see that on 1 year, 3 year and 5 year period, you are beating the index, and at least make sure that you are beating on one of the 2 of the 3 time period. If you have done it for 5 years or 3 years or 3 year and 1 year, fine. If you see that you haven't beaten the index over any of these 3 periods,
that's a reason to worry.
That's a reason to sell.
Yeah.
And as far as how often you should do it every year, not earlier than that. And you don't necessarily need to, when I'm saying that sell a fund if it has not been able to beat the index by over these 3 time period, or at least 2 of the 3 time period. But don't get very stingy about the if the index has given 6% in one time period, and if your fund has given 5.75, don't necessarily, you should not give it some margin of error. And how often? Every year, because that will be also the most tax efficient time frame. And when you see this underperformance and margin of underperformance being meaningful, substantial, then by all means change it.
All right, then, that's the wrap on this episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.